Good afternoon. Thank you for joining our webinar on the current state and outlook of the U.S. auto sector. My name is Todd Duvick, Senior U.S. Auto Analyst here at CreditSights. I, along with my associate Will Lee, cover the U.S. and Asian auto OEMs and the U.S. auto suppliers. Our counterparts in London, led by Jim Williamson, cover the European auto OEMs and the European auto suppliers. The U.S. auto sector regulatory and geopolitical landscape has shifted dramatically in the past year. The U.S.-Mexico-Canada agreement is up for review. Currently, the U.S. appears to be pushing for higher U.S. content requirements or potentially withdrawing from the agreement altogether. Tariffs have been enacted over the past year. EV purchase incentives have been dropped. Emission standards have been lowered. And finally, the Iran conflict has impacted transportation logistics, car sales into the Middle East, and gasoline prices. Given this backdrop, our three speakers today will discuss how these shifts have influenced the current state of the industry and the outlook. We will have time for questions following the speakers' presentations. You can pose your questions using the Ask Question feature at any time. And with that, I will hand it over to Karl from Experian to begin his remarks. Karl?
Thank you, Todd. So thanks, everybody. My name is Karl Kruppa. I am a senior automotive consultant within Experian Automotive. We do a regular webinar on the state of the automotive finance market. So we'll take a look at the current conditions of the auto finance industry in the U.S. So we take a look back on all open auto loans and leases on the books at the end of every quarter. So we're really looking at the overall loan portfolios of all auto finance lenders in the market. And really over the last several years, we've seen a slowdown in the growth of outstandings. Really started in that 2022 to 2023 period when we were starting to see higher interest rates in the market. We saw a lot more cash that was coming into the overall purchase behavior of consumers. So we're in several years leading up, we were seeing the overall balance growth, for instance, from 21 to 22, about 6%, 22 to 23. It's really slowed in the last 2 years in particular to about 1.5% year over year. That said, we are at a record high, about $1.606 trillion in outstandings. That's a $22 billion increase year over year. So when we look at the various risk tiers, you can see the categorizations up there at the top. We categorize super prime as being a consumer with a score between 781 and 850, prime 661 to 780, non-prime, or what I like to call near prime, 600 to 660, subprime 5 to 600, and deep subprime below 500. So looking at the overall market, loans on the books at the end of Q1, we did see a drop in that prime space. Prime still makes up the majority of open loans on the books at 35.21%, but you can see how that has been decreasing. So that group in particular has been under a lot of pressure, although we've been seeing the super prime customer penetration grow. That's now up to about 31.04%. So we did see an increase there year over year. We also saw increases in the near prime space, up slightly year over year, as well as subprime and deep subprime. So these are loans that may have gone on the books as a subprime loan, migrated into a higher tier, and now with some payment stress taking place, we're seeing them fall back into those more non-prime tiers. So you're seeing increases in both subprime and deep subprime year over year. So one of the things we do is we track delinquency, and really we're looking at early stage delinquency. So these are loans that have been on the books for 12 months, what the 60-day delinquency past due rate was for those loans. And you can see particularly, again, over the last 4 years, that there's been a pretty steady increase. 2021, COVID's still going on. There was still consumers still were spending more, had a lot more cash on hand. Once we actually started to see prices increase and the chip shortage take place and stronger demand, we started to see the early stage delinquency rate increasing. And in fact, In Q1 of last year, we see the highest delinquency in the last 5 years, about 1.25% overall. Breaking it out between new and used is at 4.5, and the new vehicle, or the total rather, at 3.05%. So we are continuing to see a bit of an increase there in that early stage delinquency. And we do break it out by risk tier. I think one of the reasons we don't hear more about this, prime is still performing pretty well, although we do see some increases in the prime space, particularly when we look at that used side of the business. We can see it's gone up. And again, still an increase, but not the dramatic increases we see in that near prime space in particular when we look at the last 5 years. Subprime did actually see a bit of a decrease, particularly on the used financing side. So on the left-hand side of the chart, you could see in that 2025 vintage that we are seeing lower delinquency rates, at least for the first 12 months on the books. I think a lot of that could be attributed to we're seeing much lower LTVs within the market in that space. So that could be one of the factors that is weighing into it. So looking at the overall finance market, when we look at new vehicles on the left-hand side, used on the right-hand side, we could see the retail grew pretty significantly year over year. It's making up about almost 60% of all the new vehicle purchases in Q1 of this year. That is up year over year. Again, a year ago, as Todd mentioned up front, we saw a lot of the EV tax incentives, a lot more leasing for EVs that was taking place. So not surprising to see a drop in leasing share year over year, as well as a drop in cash, down about 5% over year. On the right-hand side of the chart, used vehicle purchases stayed fairly steady, retail making up about 38%, and a lot of cash within that market as well. When we break it out by vehicle age group on the bottom, you could see that overall, from a purchase perspective, those new vehicles are down 5%. We still continue to see growth in that older used vehicle market. A lot of talk about affordability, and one of the things that we are seeing are more consumers switching to some of those older used vehicles as more affordable options hit the market. And on the right-hand side, we actually look at the financing for that group. Still, the majority is taking place for new vehicles. 41.43% of all financing was for new vehicles, but that is down slightly year over year. We did see an increase in late model used. That second column there that you can see is current plus 3 model years. That is up year over year, although we do expect that to decrease moving towards the end of the year as the off-lease, the number of off-leases coming back into the market is expected to go down. Looking at the overall market, we talked about electrics up front, and you could see just the impact in Q1. We're down about 39% in battery electric registrations year over year. When we look at the plugins, even a greater decrease, 59%. A lot of that really just a pull ahead of sales into 2025 when the tax credits were still in place. So that's not to be unexpected. I think one of the things we don't hear so much about, but the increase in hybrid sales continues. 14.9% of all new vehicles purchased were hybrids. That's up 23% year over year. And again, I do think affordability is playing into that. When we look at the breakdown for hybrid vehicles, you can see almost 95% of hybrids are considered non-luxury vehicles. So certainly a much more affordable option, particularly right now with the higher gas prices that we're seeing. So who's doing the financing? Well, in Q1, the banks overtook the captives as the top lender type. So you can see 28.4% of all financing done through the banks. That's an 8% year over year increase. Captive share was down year over year. We do see that the credit unions were also down slightly, and we continue to see growth in that finance company sector. So a lot of that, a lot of the fintechs that we're seeing, as well as some of the new dealer captives that we're seeing in the market now. We know Lithia has their own captive, AutoNation has their own captive. So a lot more market share taking place within those finance companies than we've seen in the past. All right, as far as originations in Q1, we did see a drop in prime origination. So you could see that prime customer made up 36.4% of the market in Q1. Super prime made up another 33.92. So between those two, that makes up 70% of the overall market, but that is down year over year, about 2.79% for prime lending in Q1. And I think a lot of that can be attributed to that pull forward in sales that we had seen in 2025 to take advantage of before the EV tax credits ran out. So we did see an increase in near prime up to 15%, subprime also up to 12.7%. Deep subprime still a very small percentage of the overall market, only 1.6% of purchases falling into that category. So speaking of affordability, looking at new loan payments, and this is the slide that always gets a couple of gasps when they see the percentage of retail loans now that have monthly payments over $1,000. We're right about 19% of all monthly loan payments for retail over $1,000 a month, and that's up 10% year over year. From an affordability perspective, leasing still your best option. About 43% of all leases in Q1 were under $500 a month, much less than what we see on the retail side, which is less than 20% of all new retail loan payments. So one way we're seeing that affordability play into the market is longer loan terms. So in order to keep payments more affordable, we're seeing growth, particularly in those 84 and 85 plus month term loans. You can see for new vehicles on the right-hand side that 85 plus month loans are now 3.3% of the market. That's about a 13% year over year increase. Loans between 73 and 84, another 32% of the market. So that's another 15.5% year over year increase there. Even on the used side, we see the growth within that space. So it's one way that consumers are keeping their payments more affordable, but it could lead to issues down the road, particularly as from a negative equity perspective, taking consumers a longer time to get back into an equity position. So another way that consumers are combating the affordability crisis is refinance. We've been seeing that market really take off in the last several years. On average, customers are saving more than $80 a month when they decide to refinance. And when you look at the difference in interest rate, really over the last couple of years, but now it's about 2.24% difference in interest that people are saving. Now, one thing that keep in mind as well is that normally it takes about, on average, 2 years into the life cycle is when people tend to refinance. So when you add that new loan term on top of that, we're now looking at effective loan terms that could be 90 months or more if that consumer actually pays every payment until the end of that refinance loan term. So again, something to keep an eye on. Obviously saving consumers quite a bit a month, but also increasing how long that they're going to be in that particular vehicle loan. So in summary, continue to see, as I mentioned before, leasing rates decrease. Still, cash was down year over year, but still remains high. Scores decreased, but overall, we're seeing growth outside of that prime space. Banks are picking up share, EV share down as we expected. Loan amounts, payments are on the rise. Rates are down, but terms are increasing overall. New LTVs are up over a year, but used LTVs have been declining over the last several years. And refinance increases with the average savings about $81 per month on average. And with that, I will turn it back over to I'll turn it over to Erin.
Thank you so much, Karl. I always love following Experian, mostly because we are with a good partnership between the two of us. And of course, a lot of the information that Karl surfaced with you all leads straight into the conversation I want to have with you about affordability and how it's really impacting the car market. So I appreciate being invited here today, Todd. Thank you very much. Moving on to just talking about our macroeconomic snapshot. Most of you listening to this call know all of this information very well, but I'll highlight it because it's important for us to think in context. We have seen GDP growth slow down. We saw that adjustment down from 2% for Q1. We still expect one more adjustment, but luckily it was rebounding from the fourth quarter where we were at 0.5%. The big number that we pay attention to, of course, for the auto market is the CPI number. So we saw that move up to 4.2%. Obviously, everyone has heard that it is in large part due to fuel and energy costs. It is up from the 3.8% we saw in May, but to keep in reference here, 2.9% is where we're at on core. So yes, it's still above that 2% we want to see, but it's not as strong as that 4.2% is potentially representing by the number alone. What's really helping us in the market right now is that our unemployment rate continues to hold pretty steady. Our labor force participation rate holding steady. And in fact, we saw a rise in jobs in our most recent reading with the 172,000 non-farm payroll jobs added. A lot of that we did see was in healthcare, of course, but then also in hospitality. And we have this small little thing called the World Cup going on right now in America 250. And so there is some speculation that some of that increase in hospitality workers may be short-lived to get us through the summer of the World Cup and the America 250 celebrations. But one can hope that those jobs are a little bit more permanent and helping to lift up um, individuals who are actually employed. The thing that we're keeping an eye on is consumer confidence, and I'll share a little bit more about this in a slide down the road here. But we pay attention to the Conference Board, of course. Their preliminary readings back in May were at 93.1. So what we're saying is that how individuals are feeling about their present situation is actually down 3.2 points, but that people were expecting things to get better, and that was up by 1 point. Largely because a lot of people were expecting that the Iran conflict would get settled and that potentially we could start to see fuel and energy prices come down. We now have the announcement that there is some sort of deal there. We don't know all the specifics, but hopefully the future is looking that over the next 4 to 6 months, we can start to see some of that fuel and energy pricing come back down. Ultimately, though, it kept us at a 16.1 SAR in May, and we see that sales are continuing to hold stable. So just to move into a little bit more clarity in that section, I'll take you through what we're seeing from an industry performance. So sales is actually improving. We saw a couple of months, the first quarter sort of opened up down, and we knew that weather had a lot of indications there, et cetera. We did go through our sales tax refund season. We were anticipating that it would actually be really great and a good tailwind for the industry. It did prove to be that, especially in used sales, but we know that some of the refund money did have to go towards stabilizing household incomes given the fuel and energy rises in costs. And so it perhaps didn't get to carry on as long as we expected. But then in May, once people started to back out of any weather, once they started settling into their new household budget situation, we saw sales improve. So we're at 16.1. We are anticipating SR for the year to be 15.8. So hopefully if we continue to keep pace at this 16 million, each month we will hit that 15.8 million sales for the year. Used sales trends are firm. The 78-day supply, manufacturers continue to hold discipline in their production, and sales pace is keeping up with that. So we're not seeing a bunch of excess supply sitting on the lots. We did see in April and May, the big incentives were moved towards getting the older metal off the lots. We knew that a lot of manufacturers last year, based on the tariff announcements, held on to pushing model year 25s into the system longer than typical, which meant we had somewhat of a hangover this year with a few more 2025 models than we typically have at this time. And so there was an effort to move a lot of those off the lots, which did happen. And in used day supply, we're still dealing with the fact that we didn't produce close to 8 million units during COVID. So we continue to see, a lower availability in used cars. And of course, they're very important to those that are price sensitive. So they're selling at a faster pace. So we're okay on supply, day supply, but it is still tight. The new vehicle pricing, I just want to hit on this because this will really set up the conversation for the next few slides. We at Cox Automotive with Kelley Blue Book publish an average transaction price every month. That average transaction price right now is sitting at $49,220. So pretty stable. It's up 1.2% year over year, but it's within a couple $100 of where it was in April. And I just always have to add the caveat that the average transaction price is really a backwards looking number. It's telling us what people purchased over the last 30 days and is heavily influenced by mix. We really are seeing somewhat of a barbell market, if you will, where we're seeing a lot of activity in that under $30,000, $35,000 range, and then a lot of activity at the 55, call it $60,000 range. And it's the middle that's getting a little bit squishy, which I'll share a slide with you in just a moment to show what that's shaping up to look like. Wholesale is doing well. It's holding stable. It really experienced quite a rush going into tax refund season. There was clearly a lot of optimism from the dealers that tax refunds were going to help. And so wholesale has maintained good year-over-year numbers and good month-over-month numbers. To show a little bit of where the imbalances sit within the market and going back to this barbell sort of theory, is you can see where supply and demand is holding up. And now this is figures that we can see through our vAuto products. So we're seeing on average listings that are what's in inventory in this moment and what's selling. It's coming on and off of listings, if you will. So under 30, you can see there we are undersupplied. Our demand is running our supply there. Same thing with the $30,000 to $40,000 bucket. What has been continuing to show as a gap as I've looked at this month over month is that $40,000 to $50,000 bucket is oversupplied under demand. It's not that or under in sales. It's not the fact that there isn't demand for that price bucket. It's that it is our stretch bucket. It's where people typically might have bought a car that was $30,000, $35,000 5 years ago, and they're coming back to market and they're seeing that car is now rising over 40,000, maybe even to 45,000, and more importantly, that those car payments, the monthly payments, are getting more expensive and unattainable for the price-sensitive customers. So we're seeing a bit of an imbalance in that particular stretch zone. Yet when you go into the 50 to 60, this starts to go into that upper middle income individual who is still able to purchase cars, not really thinking too much, too deeply into that affordability picture. We see an imbalance there, less supply, more sales. Interestingly enough, in the 60 to 80, where we would think of ourselves in that upper end of the K, we've started to build some inventory in that area. And we think that has a lot more to do with, yes, the wealth effect is keeping individuals in the market. It's certainly continuing to hold up the new vehicle market. But there was some hesitation, and we saw it in consumer sentiment around what was going on with the economy, around what is going on with potentially the AI bubble, the Iran conflict, just some more uncertainties that are being added into the system for individuals that are purchasing vehicles at that higher rate. Plus, as Karl mentioned, some significant pull ahead. Those that could buy last year, wanted to buy last year, did buy last year, and so we might be still suffering a little bit of a hangover from that perspective. So when we talk about affordability, a lot of people want to focus on that average transaction price. And it is important, but it really, as I'll show you in the next slide, has not gotten as out of control as people think it has, given what inflationary pressures there are. What really is starting to harm folks is all the other things that have to do with that transportation portion of the household budget. We have seen auto insurance over the last 6 years go up by 71%. The average loan rate on a blended basis has seen an increase of around 31%. And yes, new vehicle ATP has gone up by 33%, but that's actually fairly normal for what we normally see over 6 years. And I'll show you that in the next chart of where we got to that. The median household income has gone up 24%, though, at the same time, while median household spending has gone down, or it's increased 23%, but it's less than the household income has gone up. So yes, vehicles rose much higher, but also did all of the cost of maintaining and owning the vehicle, which goes into that overall household spending category. So where I'm talking about where it's not just the sticker price, because the sticker price tends to be the real target of the industry right now. Everyone's saying cars are just too expensive. The average car is $50,000, et cetera, et cetera. That is true. The vehicle price is higher. But if you look at this chart here, what we're showing you is that in 2012, all the way back to 2012, up until we hit 2020, we were on a very even-keeled increase of about 3.2% on average year-over-year increases in prices, normal inflationary pressure. Then we hit into the COVID pandemic, which killed us from a supply chain perspective, and as well as just work shutdown, right? And we lost those 8 million vehicles in production. So we saw a huge squeeze on demand there and supply. And by Econ 101, we saw prices go up. People were willing to pay more to get the vehicles that were available. And we saw an abnormal increase that set a new floor for what the average transaction price was. So we went up on average around 9.5% over those 3 years. But then once we hit around 22, late 22 into 23, we've really not seen much of an inflationary impact. Cars have generally been only going up around 1.5% year over year each month. So not a significant increase, and in fact, is somewhat flatline. So when you look at that dotted line, if you carried it out from where we were before, we would have landed just about $2,000 less than where we are now. So we're not so far off the mark of where we would have hit if we had never gone into the COVID pandemic. And the 4.2% above what would have been projected can easily be looked at as, hey, we've had tariffs come into the system. Supply chain dynamics did, in fact, increase demand for different supplies and therefore drove up prices for that. We've seen significant investments in creating electric vehicle propulsion. That cost a lot of money on the manufacturer's side, and therefore a lot of investment was made on that side, increasing the cost of manufacturing, as well as just a lot more technology has come into the vehicles. A lot more table stakes are out there for the consumers that have added on cost pressure to the modern vehicle as we see it today. So I say all of that to really come back to where Karl was focused, which is the monthly payment. It says it all. This is where we're looking at the real sticker shock for individuals is when they go in to finance that vehicle, regardless of whether the ATP has kept up with normal inflationary pressures, the cost of the loan, the cost of the insurance have significantly driven those monthly payments higher and higher. So for new vehicle, on average, 43% higher than they would have seen it in 2019. In used vehicles, on average, 46% higher than we would have seen it in 2019. This is where we need to remember that most individuals are shopping by monthly payment, and they're managing household spending against all other areas that have also faced inflation over these last 5 years. So their portion of the budget that can be dedicated to this particular monthly payment is really being influenced by everything else that they're having to pay for as well. So it's a dynamic and complex picture of where affordability is coming into the picture. It's not just that the vehicle is more expensive. And honestly, as Karl was also showing you, the loan terms prove it all. The fact that someone would be willing to take on an additional $10, $12, $13,000 in interest paid just to get that monthly payment down to something that they can swallow for per month tells you that really the monthly payment is what is leading the horses to water when they have to purchase a vehicle. We've seen that great increase in loans over 72 months. We've seen more loans come in with negative equity, and we've seen down payments go down versus years ago. So overall, we do believe that that affordability picture is really complex, and it's just not attributed solely to what a vehicle costs these days. When I talked about consumer sentiment, I sort of, with a little bit of a pun here, beatings will continue until morale improves. We have been going over and over on a weekly, daily basis of headlines that are really pushing people's limits on how they feel comfortable with what's happening in the environment. This is Morning Consult. Morning Consult, specifically different from Conference Board and from the University of Michigan, they measure this sentiment on a daily basis. Therefore, I like to refer to it as a mood indicator. That mood indicator really matters a lot when you have some volatile headlines and volatile situations hitting the economy and hitting individuals in the wallets. What's interesting here is that we actually started to see that those upper income quintiles began to see sentiment drop faster than some of the lower income quintiles, which again lends itself to the fact that even though the wealth effect is keeping us happy and healthy and the new vehicle market stabilized, those individuals are getting a little bit nervous about what's going on in the economy, the type of conflicts that we're entering or exiting, and what might be happening in the stock market. So it's important to keep an eye now on sort of both ends of that K-shaped economy, as opposed to just assuming that the upper end is going to keep us floating. And lastly, I couldn't discuss this without being able to share with you where we are with battery electric. As Karl said, hybrids are the name of the game these days. And it's not just because there's more demand for hybrids because of the fuel surges and so forth. It's also because we are seeing a lot more hybrid enter the market. Manufacturers have absolutely started to diversify their powertrain portfolios, and we've seen a lot more hybrids come into the market, which is a part of what's driving the increase in hybrid sales. That, of course, means that we have seen a pullback on battery electric. Now, this is showing you what the new battery electric vehicle picture looks like. And we are kind of stable here at the moment. We did have that significant drop off once the IRA credits went away. But we have seen people coming back into the market and we're stabilizing. We're likely not to get back to that 8 to 10% that we saw as total market share from last year. That's partially because we've seen a lot of manufacturers pull back on producing more electric vehicles. Some of them have even taken their electric vehicles out of the market. So there is something to be said for the fact that there's just not as many available to consumers. But certainly there's still the infrastructure barriers. There's still the charging, anxiety and things like this that stand in the way of an individual taking on an EV. That said, we have seen an enormous increase in used electric vehicle sales. We know that more and more of those will be coming into the market because of the substantial amount of leases that went through the system in the last 3 years. But also, they are some of the most affordable used vehicles that are out there. And certainly, the Iran conflict and the increase in fuel surcharges helped move people into those vehicles in the used market. So We will continue to keep an eye on hybrids growing. We'll continue to keep an eye on what used EVs are doing in the market and how those used EV sales may very well in turn prove to be helpful for increasing new EV sales. So with that, I will turn it over to Joe to discuss where we are with production.
All right. Thanks, Erin. Boy, this is and thanks for the opportunity to speak today. This is a perfect panel. I love working with Karl and Erin on this because it just tells a great story. Everything dovetails nicely. At Auto Forecast Solutions, we forecast every single vehicle built for the next 13 years, who builds it, where, when, how many, actual production every single month, forecasting. Our team's been doing it for 30 years. So we have a pretty deep bench and a realistic view of the industry going forward. If you want to find out more, let us know. I don't want to spend more time on the marketing side. I really want to dive into the data. So when we look at the automotive outlook, right now the industry is not necessarily in a very strong position. And we have to look at all the vehicles being built. We have to look at all the economics. Everything that both Karl and Erin have laid out on the table fits exactly perfectly with the story going forward. Geopolitical impacts are obviously driving a lot of decision making, the tariffs and the absolute uncertainty, and OEM supplier relationships. For years, the manufacturers love to say, we're going to work closely with our suppliers, and they really don't. They're really trying to help that balance. What we are seeing, though, is a lot of suppliers, that hard part suppliers, having more power, having more, fool me once conversations going, look, you gave me bad BEV bets in the last decade, and I put a lot of capital, a lot of stranded capacity, things of that nature. We need to work a little tighter because we all have to make money at the end of the day when we doing our production going forward. And a lot of the information on the suppliers, everyone focuses on the big manufacturers, but they don't put a lot of weight on the suppliers, and they should, because without the parts, you can't build a car. In terms of the short-term and long-term outlook, we do see an improvement over time, not necessarily in the green territory, but in a positive direction. And one of the big things is obviously OEM financial stability. When we look at decisions going forward, all decisions are rooted in shareholder value. So, real quick, the idea here is a lot of content we're going to go through, but when we look at a manufacturer's focus for the next decade, we see how are they financially stable. Shareholder value drives the decision-making process. That's the one customer every manufacturer has. We as consumers are a means to an end. We also look at, are they building the right products? The idea is, and love or hate the White House, this idea of pulling back incentives on EVs and pulling back the idea that there are penalties for building vehicles that are battery electric, actually allow the manufacturers to build what consumers want. There was a time where, and there still is a time for a lot of manufacturers, they're building products that consumers are not asking for. It's being driven by governmental agendas, environmental agendas, and when the affordability conversation is the underpinnings of every single conversation going forward, it's a real problem when these vehicles are too expensive and they don't fit the bill for the consumers. We also look at production flexibility. How well are they in tune? This is what the Chinese are bringing to the table. Chinese are bringing this idea that they can redevelop programs in 2 years. A traditional manufacturer takes 3 to 4 years. That the ability to react faster to consumer sentiment in the industry is what the manufacturers are trying to achieve. It is a very difficult task to achieve. Obviously, imagine competitive pressures all over the world and the regulatory environment, this constantly up and down and left and right, trying to make decisions on a current environmental programs and regulatory environment, as well as future ones. So if we look at this electrification standpoint, right, there's ICE vehicles, pure internal combustion engine vehicles. That's the gray. Hybrids are anything that has a plug that's not a BEV, and even standard hybrids, anything with a battery. And battery electric vehicles are obviously anything that are pure battery electric. And yes, globally, we'll see growth. We'll see about a third of every vehicles by 2033 be pure battery electric. This insanity conversation that we're all going to be electric in the next 10 years never passed a sniff test for us. In terms of North America, we're only at 5% production, and we'll get to 12% by 2033. I mean, that's not a lot of volume, but it is growth. But look at the blue. Heavy into hybridization. China's a different path. China builds an overcapacity market because they have to keep everyone employed, and they don't really build to a demand cycle. They just keep building and building and building. Yes, they'll grow, but not to this 50% idea of full BEVs. Western Europe beats by a different drum. They have smaller vehicles. They're death by 1,000 cuts in terms of in big people's wallets. However, they're getting themselves in a real tough bind right now because it is opening up a lot of Chinese competition to the traditional European players. And Eastern Europe's the new landing pad to invest to get you into mature markets. So if you look at it from a battery electric perspective, yes, 28% of pure battery electric. But if you look at an electrification perspective, you're talking about tipping point. You're talking about 60% of all vehicles by 2033 being in the electrification space, which is in the positive direction and supports all the conversations that Karl and Erin put out as idea that people are now looking at hybridization as the way to go. In terms of North America, or global, the only global market that grows is China. And that's because their model is different than every other model. We're going to have a softening and a leveling off of every other market globally. There are 6 regions and 54 countries today that are building light vehicles. The problem with North America is that back in 2016, 14 vehicle manufacturers produced the most amount of vehicles, 17.8 million units. That's a great algorithm for the suppliers. Little players, a lot of volume. Now the script has been switched. This year, 25 players doing nearly 3 million units less. That is a very big problem because the manufacturers, the GMs and the Fords, the Stellantis of the world, are having those massive competitive pressures, are having the tariff impact, are having the push and pull factors of what's going on the consumer side, and they're trying to make money. And they try to push that discounts down to the supplier. Supplier goes, sorry, you're giving me a fraction of the volume you gave me before. I can no longer build to the price you want me to build. And this continues into the future. Still, 25 vehicle manufacturers. Yes, we're going to have growth, but this day of over 17 million units in North America, it's not going to happen in the immediate future or ever. So less volume, more players is a problem. Evolutionary design shifts is where we're looking at. Stellantis is actually in a decent position on their designs. 1 or 2 or 3 platforms that are going to say we can build multiple vehicles and brands and commonize the efficiency of building all over the world, which then goes into the bottom line, which then can be passed on, not as cost savings, but as margin improvement, which again is shareholder value. The affordability conversation is very interesting. And everyone, Erin and Karl support this as well. It's not about give me a $25,000 car. It's about what is my threshold of value. If I can buy a $40,000 vehicle that acts like a $60,000 car, that falls into my affordability wheelhouse. If I can extend the loans to 108 months of insanity, that falls into my affordability warehouse. This is where the Chinese, when they're allowed to compete in America, and they're going to allow to compete in Canada and Mexico now, when they compete, they're not bringing $25,000 cars. They're bringing $40,000 and $45,000 awesome vehicles that are going to go at $60,000, $70,000, and $80,000 cars. And the only way affordability fixes at the traditional OEMs is make smaller vehicles. So we're not going to lower the price of pickup trucks. We're just going to make you a lot of smaller pickup trucks. The problem, again, in the automotive space is program cadence shift. When a manufacturer says we're going to build a product, it takes 3 years to get it from idea to birth. But the problem here is that everyone made bad bets in this space, especially electrification. They had to line up their hundreds and thousands of suppliers to get the job done, but then they pushed their programs out, which means people are trying to go to the banks and trying to shore up funds and trying to make a bet to saying, hey, we need $20 million to build the seats or steering wheels, whatever it is for this next vehicle out here. And then that vehicle gets pushed out. That is a problem in this market, and it's going to continue going forward. Light vehicle sales in this market align with what Erin says, about 15.7 million, going to be really into this next year. A little bit of a downturn from last year because we have a rebuild year going on as we speak. But we do see growth going into the future and pushing over 16 million in terms of sales by 2033. Again, this idea is protecting the market. We protect the market by allowing the local demand, local builders to build trucks and the chicken tax to basically keep people out. But you're going to see a lot of competition. Even Hyundai saying we're going to get into frames. We're going to start building trucks. And when Hyundai does it and they're going to be successful, it's really going to make a problem for the Detroit 3 going forward. So the competitive pressures are going to get harder, more difficult, trickier to navigate. And this is even before trying to let or not let the Chinese into our market. An interesting takeaway here is that battery electric vehicle that sales. Now, this is the US outlook, and there's two trajectories on the battery electric vehicle sales. The first trajectory, the one on the bottom, is status quo. There's no more incentive. In fact, the incentive was sort of a smokescreen. The incentive allowed the manufacturers to raise their prices by 7,500. So once it goes away, it makes it very difficult to make them a competing product. You have manufacturers like Ford out there that are trying to build a $30,000 profitable battery electric vehicle pickup truck, but the only way they could do it is to put a skunk works and lock their 50 engineers in California and not have the big machine involved with it. So it's very difficult for vehicle manufacturers to right the ship here. Now, when we have it, flat BEV, 6%, I'm going to take that as a win in terms of North America, in terms of the United States. It's different all over the world. If, however, we find new technologies, new chemistries, solid state takes off, prices do come down, consumers are moving faster from ICE to hybrid to BEV, then we see there is a market for 10%. Again, not a unbelievable growth path, but if you look at it, 10% of the market, that's a good trajectory to be on. We never believe this 25, 50, 100% trajectory. This idea that in the United States, we make money with pickup trucks and large SUVs. That is not where electrification needs to be. Electrification needs to be in more of the wheelhouse of crossovers, cars, passenger cars, and so on. Makes no sense. So we're going to see things like extended range come in the market. This idea of adding an engine to a vehicle, preferably a truck, that engine is a generator only, zero propulsion, zero torque, zero horsepower. It's just a generator on board. Lets the vehicle manufacturer stay in and build engines going forward. And the consumer feels safe because they have a battery electric vehicle that has an engine on board. We're seeing GM come out with new V8s, right? This is a conversation we weren't having 10 years ago. Everyone says, oh, that dirty word of V8, the dirty word of diesel. We're going to go to 6s and turbo 4s and inline 3s and everything in between. No, we're not. We're going to build cars that consumers want to get there. Cars are more efficient. Their carbon footprint is 10 times better than they were a decade ago. So we're going to go in the right direction. But this idea that building cars that consumers never wanted made no sense. At the end of the day, what we come back is we say, what is Toyota doing? Toyota always gets it right. May not be day one, but they always get it right because they have a pull methodology. They pull in the intel from the consumer saying, what do you want? And we'll build it. Everyone else has the field of dreams push methodology. We're going to build something we think you need, even though you didn't ask for it. And then finally, who's coming, right? This idea of the Chinese, this is the short list, right? Right now, the United States is the most insulated market in the world because we're basically saying if you have a Chinese chip in there, sorry, can't play. It's not tariff related. It is basically national security. That crack will open up and the Chinese will be here someday. It's not a if, it's a when. BYD is on the top of the list over there. They're the largest producer of new energy vehicles. That means anything with a plug in the world. They eclipse Tesla. They want to basically buy a vehicle manufacturer. That's their game. They have a huge footprint in Mexico, in North America, obviously, and a monster footprint in Europe, and it's really damaging the bottom line of Volkswagen over there. Chery has been trying for years on their importer model to get into this market, and they're not going to give up on that. They have a heavy presence in South America. Leap Motor is 20% owned by Stellantis. They're already building kits in Stellantis plants all over the world, not here. The vision is to bring a Leap Motor kit into the Brampton facility in Canada, but the union up there is really upset because it's going to create 30 jobs. Now, if you combine Leap Motor with Jaguar Land Rover, where Stellantis has a memo of understanding, and you put them both in Canada, you may have a win there because Jaguar Land Rovers are not built here. So that might be a nice way to put a product in Canada that nowhere else in North America has. SAIC is a juggernaut all over the world and constantly pushing. Geely owns Volvo. The Chinese are here. And VinFast was trying North Carolina. They realized it wasn't the right mix, and now they're pushing back into Mexico to buy up a Mexican facility. So the takeaway here is the competitive pressures are not going away. There is going to be some positive growth in the market, but the pain points, the tariffs, the material costs, the competitive pressures, coupled with this idea that everyone was saying that $50,000 and affordability is a nightmare. This is going to be the constant pressure that every manufacturer has to navigate in the foreseeable future. So I want to give it back for Q&A. I want to thank you for your time.
Great. Thank you, Joe. So we do have one question. I think the first question is for Karl. Karl, the increasing share for banks and fincos, is that historically indicative of anything? And the examples cited here are building stress, affordability, etc.
Yeah, if you look back on the banks and the captives in particular, you could see them kind of juxtapositioning their market share, really depending on current market conditions. So when there are a lot of incentives in the market, when interest rates are high, you do tend to see the captives stepping up and capturing more share. If the day supplies are low, the captives don't need a lot of incentives. The banks tend to pick up additional share, mainly because they have a much better cost of funds. As far as the fincos are concerned, I think this is something that's more of a newer trend, mainly because of some of the things I mentioned before. We're seeing some of the fintechs of the world that are getting into the auto space and doing more from a digital lending perspective, as well as what I call those dealer captives that are we're seeing more of now. Lithia's had theirs for a while, AutoNation for a few years now, and we're seeing more of these big dealer groups looking to really start up their own finance arms.
Okay, that's good insight. Thank you. Just a reminder for the participants on the call, if you do have a question, feel free to put that in the Q&A box on the right-hand side of your screen. Erin, I'll pitch a follow-up question for you, tied into the affordability and consumer demand, but with a bit of a wrinkle. Obviously, the gasoline prices over the past several months since the Iran conflict has been in play, prices are up dramatically, affecting affordability. How has that affected what consumers are buying? And do you see that ultimately, obviously we've got a potential agreement here, but let's say something falls through the cracks with that agreement. Do you see that affecting overall retail sales in the back half if we don't have an agreement with Iran?
Sure. So, you're absolutely right that we have seen some shifts. I will say that the biggest shift that we've seen, and remember, Cox Automotive, we do see sales transactions, but we also see shopping behavior through Auto Trader and Kelley Blue Book, and even dealer.com, which is the dealer websites. What we did see there, and it largely, modeled after when we saw the spike come in, is that there was more shopping, more looking around at hybrids, absolutely, and EVs, both. And interestingly enough, we even saw some that were keeping, causality is sort of what we're saying is the Midwest. We knew at one point they experienced a dramatic hike in gas prices, and we saw a pretty giant hike in activity from those individuals in the Midwest who were searching for vehicles. The reason I'm focusing on searching is my anecdotal answer would be I don't believe that everything we just showed you about affordability and monthly payments and interest rates, et cetera, has someone off the sidelines jumping in to go ahead and mitigate that gas price, the increase in gas prices that they have, to go buy a hybrid or electric vehicle. I just don't see where the finances would make sense unless someone who's just very well heeled and can afford to jump into the market if they feel like it. What I would say is that any individual that's in the market right now, we've absolutely seen that shift. Say if they were looking at an internal combustion engine, they very well started looking at hybrids. If they were looking at hybrids already, they very well started moving into giving electric vehicles another thought. And we saw sales follow that path as well. So I don't think it's a true statement to just say we are seeing an increase in hybrids and electric vehicles because of the Iran conflict, but it has certainly not hurt the chances for both of those powertrains to get more exposure to the market because of that increasing question around whether a more fuel efficient vehicle is a better choice for individuals to make. I don't see the shopping behavior changing much from that. I think that would just continue, right? And we know that it's going to take 6 months or longer to unwind all of the damage that's been done because of the Iran conflict. So I think we're going to still be experiencing higher gas prices and fuel prices to carry on through this time. I don't think if that conflict doesn't get resolved, that it substantially changes the picture on what's happening overall with the vehicle sales for the rest of the year. I think that we feel it's a relatively, there is demand out there. Really, it's not a demand issue, it is an affordability issue. And so that's what we just need to keep in mind when we're looking at sales trends.
Okay, great. Thank you. Joe, I think we're going to shift back to you. A couple questions on China, obviously a hot topic. Um, and these are related. The first one, when you say China will eventually come into North America, are you including US via local manufacturing? And related to that, if you were to guess, what year would you expect China OEMs to start selling in the US?
Yeah. So let's look at the book. What's our boundaries are. Canada's allowing 49,000 Chinese branded vehicles to be sold, sort of a quota right now. This coming year, that's going to open up that door. Mexico has 10%, at least 10% of all vehicles sold in Mexico are Chinese branded vehicles today. So we're sort of surrounded by it. The idea of them coming in here, it's going to be a partnership. It's going to be, they save a plant, they buy a brand up. We're going to Footloose, we're going to Gung Ho and Footloose put together as one movie in 10 years kind of thing as a result of this. Hey, looking back. But I would say you're talking about the next 5 to 10. The current administration is definitely anti-Chinese in terms of opening up the doors. The general rule with the Chinese manufacturers are anytime there's a chip in a Chinese car, it sends the information back to the motherland. So if you got to shut that off. But the important part of the Chinese here is the Chinese want market share first. Profitability will come someday. They will take a loss in every single car for the U.S. Holy Grail. They will do everything they can. If we tell them they're going to put $1 trillion in, they'll let them in. China is the bank of all the manufacturers over there. Here, we have to go to a bank and prove our value and get a really horrible rate to get to, if it's a risky bet. China's got a blank check for their manufacturers to get the United States. So they are going to test the walls every single place to find the cracks. Like I said, 5 to 10, if we have a change in the White House and White House is a little more, kumbaya, let everyone play together. There's a risk. There's a huge risk because if the Chinese come, they may not bring their suppliers with them. And that is going to be devastating to the current market. And they have some really good products they're bringing. Just look up the Xiaomi SU7 on YouTube. It is an unbelievable vehicle at $48,000 and it fights a Ferrari. And that's where they're going to come in. So it's not going to be tomorrow. It's not going to be over, one night we wake up, they're here. But they have offices everywhere. They've been testing the markets. They're buying a lot of land. And they're definitely going to do it under our rules to play nice.
Okay. Great insight. Thank you. Karl, another question for you. I'm going to test your memory and see if you can shed some insight on this. How does the market share between banks, fincos, credit unions, and captives of total financing today compared to the great financial crisis?
It has shifted quite a bit. We've seen a lot of players come and go in that time. Historically, when we talked about finance companies, we used to see a lot more of them as subprime only lenders. They were your the Americredits of the world, which obviously now has moved into GM Financial, and Drive Financial, which is now part of Santander Consumer. So we have seen a bit of a shift there. I think overall, credit unions have come in and out of the market. We've seen their market share in the last couple of years very steady, but when we first started to see interest rates going up just a few years ago, credit unions really picked up the slack, and they were actually the top lender for several quarters. But as interest rates started to go back up again, we did see that uptick in captive penetration overall. And now again, as the markets change, we're seeing fewer leasing, fewer incentives. Now the banks again are taking over that top spot. But it's constantly changing. Again, I think the biggest thing right now is that growth. It's the highest market share we've seen for finance companies since we've been tracking the data going all the way back pre-recession.
Okay. That's very helpful. Okay, we are approaching 3 o'clock, so I think that's all of the time we have for questions. If you do have follow-up questions, feel free to send those in, and we will try and get back to you with an answer. I'd like to thank each of our speakers for sharing their time and insights with us today. Slides from today's presentations will be sent out to all webinar registrants. Please reach out to CreditSights team if we can be of any assistance to you. And thank you and have a nice day.
Thank you.
Thank you, everyone.
Thanks, everyone.